Hey everybody, and welcome to my live stream on Friday, the 27th of October. And today I'm going to be talking about the topic of buying condominiums and everything you need to know about buying a condominium. So let's dive in and talk about it. So first of all, everything you need to know about buying condominiums. I get this question a lot, especially as interest rates have continued to climb. House prices have continued to not decline. And so it's becoming harder and harder for people to afford to get into a home. And so I'm seeing more people who are saying, John, can I buy a condo? What are the rules in buying a condo? So I'm going to go through from start to finish. I'm going to cover it at a really high level to give you what you need to understand to decide if you want to buy a condo and understand the big picture of it. And then we can do a one-on-one consultation and I can dive into your specifics and determine if this is really the right move for you or not. So first and foremost, why should you consider condominiums? First of all, they're usually less expensive than a single family home. So like I said a couple minutes ago, in the environment we're in right now, affordability is a major issue. Condominiums represent a lower priced home. It's an alternative to buying a single family residence. It also has a lot of benefits in that there's typically a community pool and or a community rec center. They're taking care of all of the facilities. You don't have to worry about mowing the lawn. You don't have to worry about care and maintenance of the landscaping. That's all handled by the homeowners association. So there's a lot of good reasons to buy a condominium. Now, what are some of the drawbacks? Well, first and foremost, you're part of a homeowners association. So you have restrictions. You can't park in certain places. You can't leave your garage door open. You can only have so many cars out there. Lots of different rules that come along with living in a condominium association. Another drawback is it's kind of a glorified apartment complex. Let's be honest. Most condominiums are multi-story homes that are, hey, you got you and then the one above you and the one below you. And you're kind of living in a glorified apartment complex. So that's definitely something to think about when you're saying, hey, where do I want to raise my family? Where do I want to set my roots? Well, if you're already in an apartment and you say, well, I'd rather own an apartment than rent one, great. But if you're looking for a backyard for your kids to play in, you're not going to get that in a condo. If you're looking for quiet, solitude away from people, you're not going to get that in a condo. So there are definitely trade-offs and cost. People say, oh my gosh, John, you said I qualify for $350,000. Now we were talking single family residences, but I found this amazing condo for $350,000. I want to buy that instead. Well, the problem is that you've got a homeowners association fee you have to pay for in addition to the mortgage payment I qualified you for. So if I said you qualify for a $350,000 single family home, you do not qualify for a $350,000 condo, because you have to be able to include the condominium HOA in the monthly payment that I qualified you for. So it's critical to understand that. Now, as a big picture reminder, when we qualify you to buy a home, we always look at three things. We look at your cash, your credit, and your income. But with a condominium, not only do we approve you, but we have to approve the condominium project. Now, what does that mean? Ultimately, we have to approve the project because a condominium is insured by the homeowners association, and they set rules that have to do with how much you have to pay in the future. Now, why does a lender care about that? Because we don't want the condo back. We don't want to be in a situation where the insurance payment to the condo, or the association payment, I should say, to the condo has gone up a lot because they have repairs that have to get done that they didn't set aside money for. And now they've got to do those repairs, and they've got to add to everybody's assessment, or add an assessment to everybody's homeowners association fee that takes your association fee from $300 a month to $600 a month because of that extra assessment. And we're worried as a bank that A, that extra assessment may make this not affordable for you any longer, and you're going to end up losing the home. And then B, we have to sell that condo, and it's not going to be as attractive because it has an extra assessment on there. So there's lots of things we're worried about with the health of the homeowners association, because the homeowners association being healthy means it's stable, financially healthy, statistically healthy. And so there's lots of things that we look at. So I want to kind of dive into, and I'm going to show you some charts. I'm going to show you some numbers, or some data, but I don't want to dive too deep into the weeds. I simply want to give you an idea of what banks are looking for when we're approving a condominium project. So let me go ahead and share right here. So first of all, what are we looking at? What we're looking at, this is a chart that simply says, hey, on a Fannie Mae loan, we might do a limited review, meaning just a cursory review. It might be a complete project approval, which CPM, Condominium Project Management System. And we might have to do a complete project approval. And we're going to look at different things. We're going to look at a questionnaire that we have to send to the homeowners association. We're going to look at and hold on, let me try and do this. Okay, so we're going to look at maybe a questionnaire we send to the homeowners association. But most of the homeowners associations, they don't give us that questionnaire. They won't fill it out for free. So you've got to pay sometimes $300 or $400 for the homeowners association to fill out that questionnaire. You're not going to want to pay for that until you're in contract. But you won't know for sure if the project's approved until we get the questionnaire filled out. So it's kind of a chicken or the egg of what comes first. Do we write the offer and then get the condominium details, which is typically the situation? But that means that you're actually going to be paying for the appraisal and paying for the condominium project review all at the same time. And it could end up in the end, we can't do the loan because the project does not meet the guidelines of the program that you're qualifying for. So we look at a lot of different things when we're trying to approve you for a condominium. Now I'm going to dive into some of the specifics of what we're looking at. Let me make this a little bit bigger here. So first of all, there's three different types of guidelines we're looking at: Fannie Mae's guidelines, Freddie Mac's, and FHA's. And they look at, for example, if there's manufactured housing in there, then maybe and maybe not. So it's one of the criteria we look at is there manufactured housing. Another one on here that matters a lot is the homeowner's delinquency rate. How many of the homeowners in the project are behind in paying their association dues? Now, why does that matter? Because in most cases, we need to see less than 15% of the homeowners that are behind in their association dues. In other words, 85% or more need to be paying on time. Because if, let's say, half the units are behind on their dues, they're not going to be able to meet their requirements to pay for insurance for the building, meet their requirements to keep up the pool. And if they shut down the pool, that makes the project less desirable and less valuable. So we want to keep the pool open because that makes the project more valuable for you and more valuable for the bank in case something happened and you couldn't make the payment. So we worry what's going on here if a lot of the people who live here aren't making their payment on time. Another thing we care about is called investor concentration. That's one person owning a large majority of the units in the project. And typically what they, actually, I take that back. That's not what that one is. So investor concentration is how many of the units are owned by occupants versus owned by renters. Let me make this a little bit bigger here. So investor concentration, Fannie Mae and Freddie Mac say, look, if you're buying the property as your primary home, we don't care how many of the units are being rented out. But if you're buying the home as a rental, we don't want more than 50% of the units to be rentals. Sounds a little bit backwards, but that's the way it looks at it. That's the way we look at it. And so what you have to understand is there are some condominium projects that will specifically say no investor purchases allowed. Now, why are they saying that? Because they already know they're up against the limit of how many units are allowed to be investor units. In other words, bought by a landlord to have a tenant living in it. Because realistically, if 100% of the units in a condominium project are owned by landlords, then that means it's really a glorified apartment complex that simply has different owners for each unit, but it's still an apartment complex. People aren't going to take care of the complex as well. They're not going to care about the care and upkeep because they don't own it. So it really ends up being not as nice of a facility, to be perfectly honest. And so that's what we're worried about when we look at investor concentration. Let's look at some of the other things that we look at. None of this is really that big of a deal. Let's keep going here. Litigation is a big one. Litigation is huge. So basically what litigation says is your condominium project in the middle of any litigation? The biggest litigation that happens with condominium projects is actually construction defect litigation. And so if you are buying a condominium and they're right now suing the land or the contractor for construction issues, well, guess what? If they could be countersued. If they lose, then they're responsible for paying for those repairs themselves. All of this can impact the marketability of the project, and it can impact the financial backing, the financial reserves within the project. So no lender is going to touch a loan. Now, there are some scenarios where we will, but no traditional lender is going to touch a loan in a project where there's any litigation going on. So that's a really big one. A couple more simple things that we look at. This is the one that I confused a minute ago. It is single entity ownership. Let's make this a little bit bigger here. So single entity ownership says how many units are owned by a single person. Because if one person owns 25% of the project, two things can happen. First of all, they can sell all at the same time. And that would bring down the value because it would flood the market with 25% of the units. That's very concerning from the eyes of the lender, and it should be concerning from you. Secondly, that one owner has an undue amount of voting power within the association. They personally represent, in this example, 25% of the units within that project. So therefore, you're worried about, hey, what's going to happen here? What's the stability? And so in most cases, no more than 10% of the units can be owned by one person. But in a lot of cases, we can ask for an exception if it makes sense. There's actually a project in the Central Valley that I've done a lot of loans for. I don't know that this still exists today, but there was one person who owned 15% of the units. This was about 10 years ago that I did a lot of loans there. And this person had owned these units for 15 years. And it was a stable project. There were no issues. And so we just had to submit the loan to Fannie Mae in order to get them to give us an exception to the rules. And we made a case every time we were successful that said, look, this person didn't just buy 15% of the units. They've owned them for 15 years. They haven't flooded the market with their sales. They haven't voted crazy with the association. There haven't been the problems we're worried about. And lo and behold, the magic wand was waved and we got an exception. So it can be done depending upon the circumstances. All right, let's keep looking here a little bit at just some of the things that we care about. Again, all these things are things we care about. Another big one is how much money is left over in the budget for reserves. Now, why do we care about that? We care about that because, look, there's going to be unexpected expenses. It's just like you owning a home and saying, hey, you need to have a little bit of money in reserves just in case. Florida ruined this for all of us because Florida, you've seen the condominiums projects in Florida that had major issues, that collapsed in some cases, that had major managed repairs. So they had repairs that needed to get done, deferred maintenance, neglect. And they said, whatever, we don't have the money. We can't afford it. The board voted against, the homeowners voted against spending the money to fix it. And then a few years later, the building collapses and people die. And that's changed the condo world in the last 10 years. It has really made it so that it's even harder, even more strict on the things that we look at. And the budget is a big one. Do you have enough money to deal with repairs? And are you handling those repairs on a regular basis, or do you have significant deferred maintenance? Okay. All right. FHA looks at things a little bit different. So I'm going to talk about FHA here for a quick minute. So FHA has 3 different levels of approval. They have what's called HRAP, DELRAP, and single loan exceptions. So an HRAP says the project is put in front of HUD. H stands for HUD, Rapid Approval Process. I think rapid, but it's not rapid, so I don't know why. Maybe the word isn't, the R doesn't stand for rapid. Anyway, review approval process. Anyway, HRAP, HUD does it. So DELRAP is delegated review approval project, whatever it is, but it's DEL stands for delegated. So HRAP is done by HUD, DELRAP is done by the lender. Here's the problem. First of all, somebody's got to package up all of the paperwork and send it to HUD. That's really going to fall on the homeowners association if they want their project approved for FHA financing in the future. They should put together all the paperwork and they should ship it to HUD for approval. But no homeowners association does that. So a lender could do it. The problem is the lender still has to take the time and money to send it off to HUD, and it takes a long time to do it. So HUD says, fine. We'll let the lender do the approval themselves. We'll delegate it and let the lender do the project approval. Here's the problem. That project approval is then good for every lender in the nation. Well, why would I want to dedicate my resources, my time, my money to approve a project just so now all my competitors can do loans in that project? I wouldn't want to do it. The truth is, Fannie Mae does the same thing. Fannie Mae has a condo project website that we upload all of the project approvals for. And once a project's approved, every lender can do a loan in that project. Freddie Mac is the only one that keeps their condo project approvals private. Now, that's good news and bad news. It means a lender might be willing to do a Freddie Mac project approval because then they can keep it as their ace in the hole and say, hey, nobody else can do this, only me. So it's really, really important to understand these tiers, that when somebody says this project is approved, well, is it approved publicly or is it approved only for that lender? Is it something that they will allow an exception? So FHA says, FHA originally said, if it's not approved by us, we won't do it. Now they've said we'll allow some exceptions. We will allow for individual owners or buyers to get an exception up to a limit. And so basically what they're saying is they won't let more than 10% of the units in a project be approved as a single loan exception. And so if you're looking to get an FHA approval on a project that has not been project approved, we may or may not be successful depending upon whether 10% of the units have already done that project approval, not project approval, but done that single unit review process. So just be aware of that fact. The last thing I'll tell you really quick is about insurance. So insurance on a condominium, again, kind of a complicated chart here, but what we're looking at is the homeowners association's master policy, and we're looking for, do they have general liability, fidelity coverage, and are they going to replace the project? Are they going to replace your building if it burns down, if it is destroyed? And then we look at your policy. So you have to have two policies. You have to have a policy that protects you, and then the project has to have a policy. Now, why does the project have to have a policy? Because the condominium shell is housing not just your home. The shell of the building is housing multiple homes inside. And so your insurance isn't going to rebuild your unit because the unit below you has to get built before yours does. That's really the general definition of a condo. Well, let me back up. The definition of a condo is where you own only your unit. You don't own the land below and you don't own the air above. If you're buying a single family home, you actually own the land below your home and the air above your home to a certain amount of height and depth. But a condo says, no. You've got people above you or below you, so you can't own the air above or the land below because somebody else owns some of that. So the problem is, if you're on a second story, you can't rebuild until the guy on the first story does. So you have to have insurance that protects the building, that covers repairing or replacing the building if there's structural issues. That's the condominium project that covers that insurance. But then the interior walls, the countertops, the sink and the toilet, well, you don't need to have your downstairs neighbor have those things done. As long as the load-bearing walls are built, the interior walls don't have to be built. So most condominium insurance policies don't cover walls in. You have to get a separate policy called an HO6 or walls in policy that covers all of that, so that if there's something wrong, if there's damage from water, damage from fire, the condominium master association insurance policy covers the shell and the structure. You have to pay to rebuild the interior. You also need protection for your contents. You need protection for, you know, your TV and your bed and all that stuff. So you have to have your own insurance, but it's usually a lot cheaper of insurance because it's not paying to rebuild the building. Okay. So last couple of things I want to talk about. The first thing, actually the last thing I want to talk about is be careful of a condo that's too low priced. If it sounds too good to be true, it probably is. Now, why am I saying that? Because condominiums have to be approved, and if a condominium project is not eligible for financing, then they need to sell to only cash buyers. And if they're only able to sell to cash buyers, then their pool of potential buyers is significantly smaller. And if you have a significantly smaller pool of buyers, you have to offer your house at a lower price because you've got to entice that smaller pool of buyers. But you're in the big pool of buyers. You need a loan, and you're going to look at 2 different condominiums in 2 different projects in the same town. And you're going to say, John, it doesn't make sense. This one's selling for $375 and this one's selling for $450. They're both 3-bedroom, 2-bath with a similar view. I'm going to buy the one at $375. I don't understand the difference, but obviously I want the cheaper one. It's probably cheaper because you can't get financing. Now, sometimes the listing agent understands that. Sometimes they don't. Sometimes they're simply going to say, well, I didn't know that you couldn't get financing, and they didn't put it in the listing. Now, that hurts the seller, but the truth is it hurts you more because you spent the money for the project review paperwork and questionnaire. You spent the money for the appraisal. So just be careful. If the price is significantly lower on that condo than other similar condos in the same town, there's a really good chance it's because that condo doesn't qualify for financing. But we have an option. That option is called a non-QM mortgage or a non-qualified mortgage. That requires bigger down payments. The interest rates are higher. But if we have a condo project that doesn't meet the guidelines, it's called a non-warrantable condo. We can't warranty the requirements have been met for this condo. There are programs that we can do non-warrantable condos. Typically, you have to put 20% down to do a non-warrantable condo. But if you had the money for a down payment, well, gosh, you can get that house for $375, get that condo, for $375 instead of the higher priced one at $450 because this one is non-warrantable. But just recognize you're going to have a harder time selling it down the road unless something changes to make the project able to meet Fannie Mae, Freddie Mac, and FHA's guidelines. So what are your next steps? Your next steps, if you're thinking about buying a condo, is to set up a consultation with me. Magically here in the next couple of seconds, right about now, here we go, magically here, you're going to see a QR code. So scan that QR code and you can download my mobile app and you can get the process started. You input your information and we'll contact you to set up a consultation. If you're local in the Sacramento Central Valley area, we can meet in person. If not, we'll do a Zoom call and I'll explain to you all of your options and we'll compare the pros and cons of buying a single family home versus buying a condominium and see if it works for you. So at this point, I'm really done. So if anybody has any questions that's watching live right now, feel free. If you're not watching live, then if you have questions and you're watching this recorded, post those questions into chat and I'll follow up with you later. Otherwise, I hope everybody has an absolutely wonderful weekend and we'll talk to y'all soon.